Chairman Powell, we're borrowing as a country, as a government, more than ever, with debt held by the public expected to reach 95% of gross domestic product within the next 10 years. And yet we're also paying interest on that debt at an all-time historic low, with a 30-year borrowing cost of just 2.4%. What's the reason for this, I guess some would say, fortunate fiscal reprieve at a time when Congress as an institution has shown really no sign of fiscal discipline at all? So what does it come from?
Well, it really is a long-term trend. For example, if you were to look at a graph of what the 10-year Treasury yielded, if you went back 40 years, what you would see is a ski slope down, and it's all the way down to today. This is a long-term trend. By the way, it's true all around the globe. Now, why is that happening? I think it's, first of all, it's inflation getting under control, becoming less volatile, and ultimately continuing to decline to the point where the risk of lower inflation is actually greater than the risk of higher inflation at the moment. That's part of it. It's also just aging demographics. So as people get into their later years, they save more. That creates more savings and per dollar of investment, and that tends to drive interest rates down. And I don't know that trend shows no signs of reversing or anything like that. So that's really what's going on with these longer rates.
Some have suggested that because we in the United States, that the United States government borrows in its own currency, this level of spending isn't a problem because the Fed can just monetize the debt and keep doing so more or less indefinitely. Well, what's your reaction to that talk? Are there risks inherent in it?
Yes, no, as I mentioned in my testimony, the fact that interest rates are lower does mean that we will pay less in interest. It does not mean that we can ignore deficits at all. We're going to have to get on a sustainable path. What does that mean? So the debt is growing faster than the economy. It's as simple as that in nominal terms. And that is, by definition, unsustainable. Ultimately, you will have to get it to where the debt is not growing faster than the economy. And it's growing faster in the United States by a pretty significant margin. So even with lower rates and even with decent growth, there's still going to be a need to reduce these deficits. And I would say, by the way, that's a need over time. We're not in the business of advising you when to do that or how to do it, but it is inevitable that over time we will have to do it. And frankly, if we don't do it, what happens is our children will wind up spending their tax dollars more on interest than the things they really need, like education, security, health.
In the past, you've mentioned uncertainties in the area of international trade as imposing something of an economic headwind for us. After we've had, over the last couple of years, a lot of trade measures going into effect, what has the Fed learned about the interaction between trade and monetary policy?
So the first thing I need to say is we should never be heard to be commenting on trade policy. It's not our job. We try to stay in our lane, but our lane is the economy. But we don't have any view at all, and we wouldn't express one on trade policy itself. Our lane is the economy. So in principle, anything that affects our ability to achieve our mandated goals is an appropriate subject for monetary policy. So we've been hearing now for a year and a half from companies, and I think this is fairly widely accepted now, that tariffs, but to an even greater extent, uncertainty around future trade policy is, for now, it has been weighing on business sentiment and is probably part of the global slowdown in manufacturing, in business investment, in exports, in trade. Part of the story. There's a much bigger story out there, but it's a part of that.